Okay, in handout 15, we're beginning to look at entity valuation. It doesn't get any more exciting than this if you like finance. All right, so what do we got going here? We know that the NPV method is pretty awesome because it's good for any project. It doesn't have the problems of IRR, it doesn't have problems of BCR. So because we can use it for anything, it's typically what we use for entity valuation. And here it is again, just as a reminder. So we're going to spend a lot of time when we're valuing entities thinking that, hey, maybe we want to buy this firm. So in a case like that, we can simplify our NPV equation a little bit. We break out this first term, which is the purchase price of the firm. It's what we pay to buy the firm. No discounting here because it happens at t equals 0. And then over here, this messes all the great cash flows that the firm is going to throw out to us as owners of the firm. And each one of those, of course, is going to be discounted back to t equal 0. And so what we need to know are what should the cash flows be here, and what is the discount rate that we should be using? So let's think about, first of all, what should these beautiful cash flows be? And it turns out that they should be what we call free cash flows. What's a free cash flow? It's the maximum amount of cash that we can remove from a firm in a period without screwing up its future operations. So there's two sets of these free cash flows. One is going to be free cash flows available to all stakeholders, okay? So this is everybody, lenders and owners, all stakeholders. Okay, and so this is going to be before any interest is paid, right? And then the other types of free cash flows we want to look at are free cash flows that are available to owners. So those are, who are the owners? The shareholders, right? And these are going to be free cash flows that are available after the lenders have received their interest payments. Okay, so all these free cash flows for either group are going to be adjusted for project-specific risk, and they're going to be computed after income tax. So they're called after-tax cash flows. When we're talking about cash flows available to all stakeholders, we call them unlevered cash flows. That's because they're before the leverage effect of paying interest. And when we're talking about free cash flows to owners, the FCFEs here, these are called our levered free cash flows, and that's because they happen after the debt holders have been paid their interest. So let's think about our formulas for getting an NPV now that we know what free cash flows are here. So if we're thinking about the NPV of the project, should we buy this firm for owners? We have the purchase price here, and then we have all of, what are the cash flows now to owners? They're free cash flows to owners, and we're going to want to discount by the appropriate opportunity cost of capital for owners. That's why I have ROCC comma E there. And when we're thinking about all of our stakeholders here, we have the NPV to D plus E. That means all stakeholders, debt holders and equity holders. So now we have the price paid here by debt and equity. That seems weird. I'll come back to that. And then all the free cash flows that are going to be available from the company once the ownership has changed, available to all the stakeholders, lenders and shareholders. And now we want to discount by the appropriate discount rate for everybody for debt and equity. That's a different discount rate than up here where it's just equity. All right, so let's go back to this term. What do I mean by the price paid for the firm by all the stakeholders? That's kind of weird, okay? What this really represents is the cost to purchase 100% of the shares of the firm and all the debt. And we talked about this in class. Anyone who issues debt to a company, bondholders or a bank with a loan, if they have half a brain, they include what's called a change of control put in the contract, and that essentially says if the management, the control, the management of the firm completely changes, it might be changing from you that I gave the loan to and who I trust and I think is going to do a great job with this company to someone else who I think is going to do a horrible job with the company and maybe make it go bankrupt. So I'm the banker, I'm the bondholder, I made the loan, I bought the bonds when you were in control. If someone else comes into control, I have the right to make all of those bonds or all of that loan due and payable immediately. So the new person who buys the firm doesn't have to just buy 100% of the shares, but they got to find someone else who's going to lend them the money to pay off the debt. Okay, so how do we compute our free cash flows? We're going to do this to owners and to all stakeholders. So let's start with owners, okay? And we're going to use for this whole term simple case accounting, which is going to include the only non-cash expense is going to be depreciation. There's no preferred stock, nothing, no warrants, nothing like that going on. And the free cash flows, when we're talking about owners, free cash flows, how do owners get cash flows from the firm they own? As dividends. So the free cash flows are going to be the maximum dividends that can be issued to the owners without screwing up the future prospects of the firm. And these free cash flows are going to be project risk adjusted, and that'll be matched with market risk adjusted cost of capital for discounting. Okay, so if we use all those assumptions, we can show that the free cash flow available to owners is going to come from mucking around with the cash flow statement, the indirect version of the cash flow statement that we all know and love from financial accounting. And you don't have to know all the machinations, but you should know the net result, that the free cash flow available to owners, if we have this simple accounting in a given period, will be net income plus depreciation minus changes in working capital minus capex plus any changes in debt. And as always, good to remember that you can't get any of these things in the future without estimating the future income statement, balance sheet, cash flow statement. So that means we're going to need what we cover a little bit later in Chapter 17, pro forma projections in the real world to make this all work. And when we do this, we also want to make sure that everything is calibrated so that the dividended amount is a free cash flow, the maximum amount we can give to owners without screwing up the future prospects of the firm. Okay, for all stakeholders, things just get modified a little bit. I'm not going to go through all the gory details. You should just really know that there's a minor change to the formula on the prior page, which is now instead of net income here, we have this thing called NOPAT. And NOPAT is EBIT times 1 minus the tax rate, and it's short for net operating profit after tax. So if we're getting free cash flows to everyone, all we do is replace net income with NOPAT and remove the delta debt term we had for shareholders, and we are good to go. Okay, so now what are the appropriate discount rates to use? So we got for the NPV stuff, we've got what cash flows to use. Now we need to know what discounts to use. And it turns out it's going to be for owners, it's going to be RE, which we've already seen how to make from CAPM, and it's going to be for everybody what's called the weighted average cost of capital, RWAC or just WAC. Okay, so let's go through this. So what's the appropriate discount rate for when we want the NPV to owners? What's the appropriate discount rate when we want the NPV to everybody? The answers are, when we want the NPV to owners, we're going to use that cost of equity financing. And how did we get that? That's going to come from CAPM or some other model. And we saw in the last chapter how to compute that from CAPM. If we're getting the NPV to all the stakeholders, then we're going to use this RWAC thing, which is, the way to pronounce this is weighted average cost of capital, RWAC, or just WAC. Most people will just say WAC here, and they mean this. They mean R sub weighted average cost of capital. So we've got this formula for it here. Let's just jump over to the next page where we have it again with some details. Okay, so this is what we want to discount with when we're computing an NPV for all stakeholders. So it's the weighted average cost of capital, and it's 1 minus the tax rate times the pre-tax cost of debt capital times the weight of the debt plus the equity cost of capital, that would come from CAPM or something, times the weight of the equity. Okay, and again, I've got all of these in great gory detail for us down here. RD pre-tax cost of debt financing, and we know what the tax rate is, we know what RE is. WD kind of looks like a new term. That's the weight of our debt financing measured by our debt to enterprise value ratio, debt over debt plus market value of equity. And we just use market value of equity when we have it. If we don't have it, just use GAAP value of equity. That's completely fine. And then down here, we have the weight of equity financing, which is just the market value of equity if we have it, otherwise GAAP value of equity divided by D plus E. It's also mathematically equal to 1 minus the weight of the debt because they have to add up to 100%. Okay, so in summary, I just wanted to put everything that we need in terms of cash flows and discount rates together in one place. So when we're computing net present value for shareholders, we use this equation to get the free cash flow for owners, and these are our levered free cash flows. And what we use to discount those is going to be RE from CAPM. It could be from some version of our opportunity investment model or etc. Okay, and when we're finding our NPV to all our stakeholders, to get the free cash flow, we just replace net income with NOPAT, and these are called our unlevered free cash flows, and we discount those cash flows back to t equals 0 with our weighted average cost of capital. All right, so then in this chapter, we looked at several evaluation methods for answering the question, what is this entity worth, right? So the first one was the simple dividend discount model, which says two things. First, it says the value of a firm to its owner is the present value of all future dividends. Okay, fair enough. And the second thing it says is assume that the firm will remain in steady state forever. Maybe not so fair enough. I've never heard of a firm that's lasted forever, but whatever. Let's plow ahead. Let's get rid of this. Don't know how that happened. Okay. So if it remains in steady state forever, all the free cash flows in every year are the same. And guess what that means? It looks like we have a perpetuity going here, and we've got our perpetuity equation in terms of free cash flows. The free cash flow in any given year is equal to the present value of this perpetuity of free cash flows times our equity discount rate, which comes from CAPM or whatever. So we can get the present value through the awesome power of algebra. That's equal to the free cash flow in any given year divided by the equity cost of capital. Okay, so you know my theme. All our models are bad, and I'm keeping this GP rated here, so I'm not saying all of our models suck in finance as I would in maybe some other venue. But anyway, why is this model not so good? Well, steady state. There's never a company that's exactly in steady state. Revenues go up and down, costs go up and down, and lasting forever is a highly improbable assumption. Okay, so the second model that we looked at was called the Gordon Growth Dividend Discount Model, and that said a bunch of stuff, and we didn't spend too much time on it, but it said in particular, let me just back this up, the value of the firm to owners is the present value of all the future dividends. So far, so good. Okay, but now it makes this outrageous assumption. The firm's dividends will grow at a steady rate G forever. So that's a totally hopeless assumption. So you can go through the rest of this. I'm not gonna bother. This is such an improbable model that growing forever or lasting forever that we didn't spend much time on it, and I didn't ask you to do any numerical stuff with it. Probably what you do want to know about the Gordon growth model is its definitions as defined here with these two statements, and the answer to the question, what is wrong with this model, which are these two improbable assumptions. And then the next method that we looked at for owners was the purchase, manage, sell model. This was a more realistic model. This is probably something you can expect to see on the final. And the basic idea is we're going to buy the firm, we're a competing firm, we're going to buy them, or a private equity firm, something like that. We're going to buy this firm and we're going to manage it for a while to maybe improve its free cash flows, or maybe market conditions are just crappy and we're waiting for market conditions to improve. And then after, in the fullness of time, a few years, when we've revved up those cash flows or market conditions have improved, we're going to resell the firm. So this is a very typical private equity firm strategy. And let's get rid of that. Okay. So with this model, our NPV equation becomes a little bit more straightforward. It's got an additional term, but it's more straightforward. Believe me, here, I'll show you why. Okay, so what do we have here? So P comma E, that's the price we pay for the firm that out of the owner's own pockets, PPE, okay? And then here, starting at the end of a year, every year we get a free cash flow from the firm that we have to discount using the equity cost of capital back to t equals 0. And then at the end, when we're going to sell the firm, so that'll be time tn, we have this blob of cash. This is a positive blob of cash. What does that represent? It represents the blob of cash we get for selling the firm. So it's the sale price of the firm. So here are all these quantities for you to look at in detail if you want to. So let's make sure we understand how to get the free cash flows and the selling price for this. Okay, so the free cash flows are going to come from our general free cash flow equation for owners here. And as usual, we have to compute income statements, balance sheets, etc. to get these guys, okay? And then for SPE, realistically, in the real world, what a private equity firm is going to do is they're going to have an estimate of the PE ratio of the firm when they think market conditions have recovered or whatever, and then using the definition of the price to earnings ratio, you can say, here's our estimated net income, say 5 years out when we're going to sell the firm, times our estimated PE for the firm 5 years out, and that's going to be our sale price. So they'll do something like that to come up with an estimate of the sale price. Just a quick reminder, for everything we do here, these are after tax for the entity, but not necessarily after tax for the owners of the entity. So for example, for example here with our free cash flows, these are after the entity has paid tax and all that jazz. And the sale price, the entity is not going to pay any tax for selling itself, but whoever owns the firm may have to pay some capital gains tax on that. So that's just our quick reminder on that. And that's it for what we covered in handout 15.